Welcome to Aha Math and Science. In today's video, we'd like to take a look at the big picture of VIX. As you guys can see that the VIX was actually measuring the volatility of the stock market, and in the past week and actually the past few weeks, the VIX has been rising and indicate that investors see a lot of volatility in the stock market. And actually for the last week, the VIX closed on a weekly basis at 19.32. That was actually the highest weekly close since March of this year. So on this chart, I also plotted the VIX against the SP 500. So, and this purple curve is basically the 50 week moving average of the VIX curve. And if we actually try to take a look at the big picture, for example, since 2013 up to the present time, which is about 10-year frame, you can see that just for this recent sort of a few years, you can clearly see that the 50-week moving average is showing a very interesting pattern. And let's actually kind of trace out that 50-week moving average. You can see that actually, if you group these two things together, which is very adjacent to each other, one is basically the VIX the spike, and the reading to the 50-week moving average also shows like a peak. This was happened in 2020 and 2021, and then followed by another peak, which is the recent bear market started in 2022. You can see another peak, and then it's coming down. So it's a very clear sort of double peak structure. There's a plateau here, which is basically indicated investors already kind of see volatility even in 2018 and 2019, and then and eventually kind of become like really this spike. So these two things really not like isolated. It looks like it's really just like a two peak structure, and it turns out that such structure also happened in previous bear markets. Let's take a look. So this was a bear market in 2008, 2009, and that was basically the great financial crisis. As you can see, again, this is the purple curve is a 50-week moving average against the SP 500. And prior to this spike, which is essentially the middle of the great financial crisis, you can see that there's already kind of a plateau region and then also a peak. And then investors will really not kind of like feel easy, even after the great financial crisis has passed. You can see the subsequent volatilities leads to another sort of secondary peak, which happened in 2011 and 2012. So again, some kind of double peak structure usually happens on a time frame of 3 to 4 years, which is really adjacent. So this is kind of really interesting for the big sort of like bear markets. They're usually the VIX has like two double peak structure, and then eventually kind of again a new cycle kind of starts. But notice that like this second peak is actually smaller than the primary peak. Unlike this case, again it's kind of smaller, but the peak amplitude more comparable. Here, the second peak is a lot smaller than primary peak. So that's the 2008, 2009 great financial crisis. Let's take a look at another one, which actually happened during the dot-com bubble and a subsequent sort of slowdown the economy, and the economy actually entered a recession. So this one you can see again, the 50-week moving average of the VIX shows another sort of like primary peak, and actually in this case, there's more really volatility even in 2002 and 2003, leading to the secondary peak is actually even higher than the primary peak. So again, very clearly a double peak structure within kind of like a 3-4 year time frame. Very, very interesting. As we can see, like just in the past 25 years also, we see these three big bear markets, and you always see this double peak structure. So very, very interesting. Now, what is really even more interesting is actually what happens like after, at what time we can really claim like the bear market is over, and then, we are entering a new bull market. That is, if you actually, for example, look at this case, which is the 2000 bear market. If you take a look when the curve after for the second peak, when the peak starts kind of low over, and at a point when the peak is kind of like, a point that is below even the low between the two peaks, right at here. This is where the low of between these two peaks. And then right at this point, the VIX 50-week moving average started fall below this low between the two peaks. And that's when we can clearly see that actually, the bear market is over, because the low of the bear market actually happened like more than like a year early. And then the stock market is kind of already in this new bull market territory. And then what's really interesting is actually, if you notice, every time, after this point, we can pretty much say like, we are more or less like the bear market is kind of behind us. But you always see these spikes in the VIX on this weekly chart. And sometimes the spikes can be very high and exceeding the 50-week moving average right at here. And then another one here, then another one here, and another one here. Every time, when the VIX spikes, obviously you can see that it corresponds to a dip in the SP 500, which are really kind of buying points, because the long-term kind of bull market has started. We cannot really tell when the bull market will end, but it would be at least like a year or 2 years, ahead, before a new bear market kicks in. So, these small sort of like corrections provides a very good opportunity for entering the market or, increase, positions. So this was in actually the 2000 bear market. Now fast forward to the 2008, 2009 bear market. As you can see, again, you can draw this line. This is the low between these two peaks. And then this is when actually the VIX 15-week moving average falls below this low. So, and that's after that, you can again see the VIX spikes. But these again represent kind of like times that you can actually enter the market or increase positions. So every time when the VIX spikes, you have a dip, in the SP 500, and something here also happened, a dip and another dip at here. So all these dips are really representing buy opportunity. But in this case, it's actually really interesting, because when the VIX cross over this low between the two peaks, the bear market is long over, but as you can see, in this case, the second peak is really kind of like a much lower, amplitude. So, but represent like uneasiness among the investors. People will think maybe there's a second leg, but it did not really kind of materialize. But the investment, basically, market participants still feel like uneasy, about the market, and feel like there's, maybe more is come, but it did not really kind of happen. Nevertheless, the VIX did kind of spike again and produce a secondary peak. But after this crossover line, you can see every spike in the VIX represents a buy opportunity. But eventually, obviously, after a few years, you have a new bear market comes in. So let's actually come back to the current present time. You can see the double peak structures, and this is the low between the two peaks. And now it seems that we are kind of really falling below this low. So let's take a close look at what happened in the past 3 years. So this is the chart here. This is the low, represents the 50-week moving average for the VIX, which is the low between the two peaks, because you can see recently the VIX is been falling down. And right at here, just like, maybe, 1-2 months ago, actually about 1 month ago, actually the VIX falls below this crossover line. Really kind of represents most likely the bear market is behind us. In fact, the low of this bear market was actually October of last year. Now we are actually really in a very interesting sort of like in terms of near-term, intermediate-term frame, is when the VIX just spiked above this 50-week moving average. And based on the pattern, based on what we have seen in the past few, the past two bear markets, I think there's a very likelihood this spike represents a dip in the SP 500, represents a buying opportunity, or increased position or initiate positions. And because most likely there was a lot of still quite some upside room left, because we just kind of enter this new bull market. But obviously you never know when the bull market will end. But here we can see that it's definitely the double peak structures. So for this particular bear market, it's over. We are in a new bull market, and these spikes represent a buying opportunity for us to actually enter the stock market. So very interesting pattern. I feel like I just want to kind of share this information with you guys, with viewers of this channel. So I hope that you find this information interesting, and hopefully maybe give you some view from a different angle. Again, thanks a lot. Always, your support, means a lot to me and motivates me to continue making videos and share my analysis. So if you like this video, please do not, forget to click the like button. And also, more importantly, feel free to, recommend this channel to your friends, and I hope, viewers, more viewers will also kind of comment in the comments section below, and we can discuss about, essentially exchange ideas, right? And so that benefit, everybody. Thanks a lot for your support, and please do not forget to click the like button and also smash the subscribe button if you have not done so. And have a great weekend.